So if you're paying on your student loans, tell me if you've been here. You're making your payments every month, you're paying extra, you're actually paying a lot extra. You're making a whole other extra payment a month, but the balance just doesn't move. What the f? Sometimes you even swear it's going up. Look, what is going on here? The interest on student loans has got to be one of the most predatory, evil financial products out there. I mean, it's not going to get as bad no matter where you look, other than student loans. And to make it worse, pretty much to get qualified for a student loan, you need to have a pulse and a social security number. If you have those two things, you're approved for thousands of dollars to screw up the rest of your life. But if you already have the loans, it's too late. What can we do about it now? So let's break this open layer by layer and explore why these things suck so bad. But first, enjoy this little clip of Hank acting crazy to lull you into a false sense of security like the next 10 minutes of your life isn't going to be absolute hell. So to really understand how student loan interest works, we need to break it down into a couple different parts. There's a couple different things to understand. And first and foremost, we need to understand what type of loan we have. I did a video on that, and that is linked up here. Just pause this, give that a quick watch so you can figure out the differences between the different loan types. But really, it only matters in that unless you have a subsidized federal loan, that's where the government is paying the interest for you while you're in school. All of the rest of them, from day one till the time it's paid off, you're accruing interest. The only real difference is the repayment terms and the interest rate. But what we're looking at here is how the interest actually is charged to you, how it's accrued, and that's really what makes the difference here. The second thing is the interest rate. The interest rate, which we will get into, the accrual terms, compounding interest, and the ramifications as far as repaying the loan, and some tax benefits at the end. So moving into number 2, the interest rate, the APR. This is pretty standard with federal loans. You're going to pay a fixed rate, which is, there's no secret about it. This is the interest rate. Nothing's going to change here. The only real difference is with private loans, that's where you can have variable rates, and you could have up to a 12.99% rate in 2019 under a private loan if your credit's not good enough, or it can be as low as 2 point some percent. So with private loans, you have a big spectrum of where your interest can lay, but for federal loans, they're all very standard. Number 3, the accrual terms. Now this is the ugly part of this whole beast, and I'm just going to explain how on a normal student loan this works. So from the day your student loan is dispersed, which means it is sent to the school, it's used to pay for your classes, your books, your on-campus stay, whatever. That loan begins accruing interest. Now what that means is interest is being charged, and it's kind of sitting out there in limbo as unpaid interest, and it hasn't yet capitalized, which means it becomes concrete and lands on top of your loans. It's just kind of floating out there at this point, just growing every single day. You're accruing interest. Your interest rate divided by 365 is the daily rate that this is growing. Something to keep in mind. So it just keeps on growing every single day from the day the loan is started all the way until the day the loan is paid off. And in that time, you're going to add to it with new loans for new semesters, new years. You're going to, as soon as you graduate, they're going to be nice enough to give you a 6-month grace period before they want repayment on the loans, which sounds great, but during those 6 months, interest is going to keep growing on those loans. So really, it's a good way for the banks to make a ton of money on you in those 6 months while you're getting your life together. On top of that, most times you don't even see this interest. If you check your statement, a lot of times it's not right there out there in front. You don't even know that it's coming. It's just you see your amount and assume this is what I'm going to pay. But really, you have a massive ball of interest that's accruing from day one, just getting bigger and getting more pissed off every single day that, surprise, 6 months after you graduate and it's time to start paying back those loans, it capitalizes and lands right on top of you.
I am very, very sneaky, sir.
And to make matters worse, you have the grace period. You actually have the option, most times, depending on your income, to defer your student loan payments, and you can defer for a whole nother 4 years. So you're just going to let it grow for another 4 years, compound interest for 4 more years. And it seems like everything's going great until you realize, no, this interest that I have to pay before I can touch a dime of what I actually borrowed, it's just growing huge on top. So every day until you completely pay your loan off, your interest is just growing bigger and bigger and bigger every single day. And it does that with, I'm sure you've heard of this, compound interest. And yeah, the same compound interest that'll make you rich. You see those things online where if you can just save $50 a week every week from the time you're 18 until the time you retire, you'll have $1 million because of compound interest. The same compound interest that Albert Einstein said was the most powerful force on Earth. Well, what would happen if the most powerful force on Earth worked against you in the opposite way? You see the charts where it just grows like this. It just keeps growing on itself, on itself, on itself. And I'll tell you, the good news is you can't find compound interest in auto loans, on most mortgages, on personal loans, on credit cards. That's all simple interest, which is easy to deal with. But with student loans, you are talking about compounding interest being unpaid and left to go unchecked for years. I think 4 years, 4.5 years if you go to school, graduate on time, take the grace period, but then you start making your full payments. If you're one of the lucky ones, you 4.5 years where it grows. Or if you're going for a master's degree and then you're deferring your loans for up to 48 months, this could be growing for 10 or 12 years. So this is how it grows so fast. And you hear reports of people with a bachelor's degree that have $100,000 in debt. Well, all that takes is one unfortunate change of a major, a grace period, and a couple year-long deferment, and all of a sudden their $38,000 loan is now $90K, and they have to pay $50-some thousand of interest before they can take a dime off of that principal balance. And this is the scary part, the compounding interest. So just finding information out on student loans is really scary. And if you go online, you will find so many websites that are either backed by the banks or by the government who are dispersing these loans for these banks. And it is so hard to get clear information. That's why I'm doing this channel. But another great resource out there is called Student Loan Hero. And I actually stole this graphic from their website. And in green, what we're looking at, in green, the original amount borrowed. That's assuming that you only borrowed $5,000 a year, well, 4 years while you were in school, to show you what happens to the interest. So by the time you graduate and start making your payments, this is assuming that you were making your payments when you graduate. You're not taking a grace period or a deferment or anything like that. You're just making payments as soon as you graduate. Well, after those 4 years, the $5,000 loan you took out as a freshman has accrued and compounded $1,400 worth of interest. Sophomore year, $1,050, $700 in your junior year, and then $350 in your senior year. So it just grows huge like that, and it keeps compounding. Well, let me ask you this. You know how much money you took out each semester. I'm sure it was probably more than $5 grand. What happens to that interest if you take your 4 years, your 6-month grace period, your 12-month deferment, and say maybe you went and you got your master's degree, so you also have some huge private loans too. So you graduated with $50,000 right off the top before interest. How does that interest grow through these different periods? And that's where this really turns into a monster. When it comes time to start repaying these loans, that's how you can be throwing these massive payments in its direction, and it's not even flinching. It's not budging. You're barely licking the principal, and that's because all payments are going to first go to fees, secondarily they're going to go towards accrued interest, and then third, anything that's extra after that interest is paid off will go towards your principal. So having a $20,000 student loan and assuming that you're going to be able to pay $5,000 a month for 4 months and pay it off, you're wrong. You might spend that first $5,000 payment just completely on interest that it's just gone. So what can we do about this? There's gotta be something. Well, if you're still in school or if you're going back to school, you have the option of making small payments to pay accrued interest only, interest payments. And a lot of times it's like 30 or 50 bucks a month. But what that does is as that interest is growing, you're just paying it off and smacking it down. Then it'll grow and you pay it off. You're not paying off any of your principal, but you're stopping all of this interest from growing as you go through school. So that way, when you graduate, you have very little interest and all of your payments are going directly towards principal. So you're gonna get these things paid off real quick and you're not gonna deal with that nauseous feeling of making your $1,500 payment on your loans that 7 cents came off your principal. And that happens a lot, guys. I'm not kidding. If you're thinking this isn't going to be you and you haven't done anything for your interest, I promise you, the first time you go and make that huge payment, it is going to hurt. Another method, and I plan on doing an entire video about this because it's powerful. Not a lot of people do it, and it can get a little bit deeper than this. But if you have a $700 a month minimum payment, you pay on the 20th. If you would pay $350 2 different times during the month and break that payment in half, you are going to pay off a loan, on average, a 10-year loan, a whole year sooner, and you're going to save yourself thousands of dollars on interest depending what the amount. And here's why. If you have this massive ball of interest that's accumulating, but you're making your payment twice as frequent with the same amount, you make your payment, the amount is now this big to accrue interest on. Instead of you have this massive amount to accrue interest on top of, you're slowly but surely knocking down those amounts faster, and you're not giving it a chance to accrue interest like it would like to. This is very strong. You can do this with your car payment, with your mortgage, with your loans, anything. You can do this. Then there's also the debt snowball, which isn't really recommended here with student loans because they'll be broken down before you consolidate them. And the debt snowball says that you can go ahead and pay the smallest ones first. But with all of the interest that's accrued, you might just be better off paying the highest interest loans first, especially if you have private loans. Just knock those high interest loans out first. That's really where the debt snowball, where its weakness kind of is with student loan debt because of the way interest works. And then number 6, one of the very few things that are good about any of this is, as of 2018, 2019, student loan interest is tax deductible. Now, that doesn't mean it's going to give you a bigger tax return, but don't get confused with a tax credit, but you can write up to $2,500 of student loan interest off of your taxes. I mean, that could be huge, especially if you're making all of your payments. That's basically, think of it as a $2,500 tax write-off when you start paying these loans, and kind of get that in your mind, because psychologically these will really beat you down fast when you're paying them off, especially if you didn't do anything about them when you were in school, and if you took out max amounts, especially if you went into a master's program or higher. It can be really disheartening, guys. So I want you to just, as soon as you get rid of that interest and you can start biting into principal, it's not going to come back. You're not going to be making these huge payments for nothing forever. You're going to get on top of this interest eventually, and when you do, you're really going to see that you're knocking out this principal, and you're like, yeah, I'm going to pay these off one day. So stick with it. Don't get down on yourself. It's not forever. And really importantly, what I would ask is, knowing what you know now, and hopefully having learned something from this video and from my student loan series, is your younger family members, maybe your kids, your brothers and sisters, your nieces and nephews, let them know that before it comes time to decide to go to college, that we need to understand what student loans entail, number 1. Number 2, to appreciate the power of daily accruing and daily compounding interest, because this will punch you in the gut in a second, and it will absolutely wreck you. And I mean, there's like 12 people in the country that have over $1 million of student loans. Just tell me, how does that even work? How much interest is compounding on $1 million every day? I think if I had $1 million of student loan debt, I would just pack up my things, leave the country, and go start anew in some third world country, honestly, because you will never get on top of that. I don't care if you're a surgeon, and actually it turns out a lot of these people with huge debt are orthodontists. So apparently it's very expensive to be an orthodontist. And I'm sure, you know, even if you make $250,000 a year, I mean, you're going to be living like you make 40 just so you can pay off your loans. Think about it before you decide to spend all this money to go to school. It just doesn't make sense. But that's neither here nor there. You already made the decisions. There's nothing you can do about that now. But understand how this interest works. And as a recap, the 4 things you need to know about: the type of loan, the APR on the loan, which is the interest rate, the way the loan's interest accrues, and the fact that this loan's interest accrues and compounds daily. The best compounding interest you can find for your savings account is monthly. This is compounding daily. And then there are a couple of different methods on repaying the loan that'll help you out. There are those tax benefits in place where you can write off $2,500 of your interest expense. So kind of keep that in mind. And like I said, don't get down on yourself. This is not going to be forever. Make your payments, pay extra when you can. I have a video coming up about actually pay student loans off. That's coming soon, so stay tuned for that. We're going to talk about a couple different things, a couple different misconceptions, and a couple warnings about just going haphazardly, making these extra payments, thinking you're going to be paying off principal. Everything like that's coming up. So thanks for watching. If this video helped you, and I hope it did, hit the like button, hit the subscribe button, leave a comment, say something nice, say something mean. And if you say something mean, subscribe so you can say something mean again next time. And we will see you then.